Hey, welcome to Tomorrow Investing. In this one, we're going to explain call options. We're going to try to explain both sides of the call option, the buyer of the contract and the seller of the contract. We're also going to cover why would one want to buy a call option and why one would want to sell a call option. We're also going to go over the positives and the negatives. And finally, we're also going to talk about how one could generate extra income by selling a call option. Without further ado, let's get on with it. Alrighty, let's explain some call options. We're going to try to explain both sides of the call option. Being the buyer or buying the call option, and we want to cover the other side of it, selling or being the seller of the call option. And you would want to sell the call option to make extra money. So let's get on with it, shall we? Alrighty, let's start off with meeting Sue. Here's Sue. Sue so happens to own stock in a company called ACB. So she owns stock in ACB. She happens to own 100 shares of ACB stock, so which is great. So Sue owns ACB 100 shares, and each share is going for $10. So Sue owns ACB company. It's worth $10 a share. She owns 100 shares, which would be a total of $1,000. Let's get the $1,000 down there. Okay, so 100 shares is what you're going to need in order to sell or buy call option. Well, not buy them, but 100 shares equals one option contract. So let's put that right there, I guess. All right. So Sue is the seller of the option contract, which is she is wanting to sell what is called a covered call. And the reason why she wants to sell what is called a covered call is because she already owns the 100 shares. So she's going to put up the 100 shares as collateral. That's why it's called covered, because she already owns the stock. If she didn't have this 100 shares and she didn't own the stock, it would be called a naked call, which is way more riskier. And Sue wants to generate extra money, so she wants to generate this extra money for selling covered calls. She doesn't really particularly want to get rid of her stock, but she's got her shares covered just in case, the worst happens, which isn't that bad. So she's looking to sell a covered call. And how do you sell a covered call? Well, first you would have to pick a price target, and Sue would like to not be so risky. So she wants to sell. So she ends up having to get rid of her shares. She actually wants a decent price for them. So she wants $15. So she's going to select a price, which is called the strike price, $15. And you need to pick the date, which is usually always ends on Friday. And so we're going to pick March 4th, which is Friday the 4th. So, and for the contract, she is selecting the $15 mark by March 4th. And for that reason, she is going to get 50 cents a share. So it's 50 cents a share times the 100 shares. So she will collect a $50 upfront fee right there. So Sue owns ACB. It's worth $10. Stocks, she got 100 shares worth $1,000. She wants to sell a covered call for a $15 strike price by March 4th. And for selling this covered call, she is going to get up front, add it to her account today as soon as the option sells, 50 cents per every share. Since she owns 100 shares, she's going to collect $50. Now, that is her premium. That's what that's called, a premium. And she gets to keep that premium no matter what happens. Now, let's introduce you to Bob. Bob doesn't want to sell call options. He wants to be the buyer of the call option. So Bob's the buyer of the call option. So there we go. So here's Bob. He's the buyer. He's the one paying the 50 cents a share up front, so the $50. And he agreed with Sue that March 4th is the end date, and the stock price, which is $10 at the moment, needs to be $15 or greater, and Bob has the option, but not the obligation to buy her shares from her. But if by any chance the stock price does shoot up and it goes $15 or higher, Sue will have to give up her shares for $15 a share plus the 50 cents. So technically, Sue will be awarded $15.50 per share total. The 50 cents that she got up front plus the $15 that she's going to get on March 4th. Because if the stock price shoots up $16, $18 a share, $25 a share, Sue is only going to get $15 for her stock. Bob's hoping that it will go to 15, 16, 20, 25 because he's got her under contract. This is a contract that she will sell him her shares for $15 a share. And by March 4th, if it's $25 a share at the time that the market closes, then he'll buy her shares for $15 and turn around and sell them on the open market for $25 and pocket the difference. But if for any reason that by March 4th, the $15 price target mark was not reached and the price plummeted. Now this is the risk that Sue takes for selling the covered call, and this is the risk that Bob takes for buying a call option. Is the price did not get to $15 by March 4th at the end of trading day, and therefore Bob's loses what he paid the premium for right here, the premium of 50 cents a share. So he lost $50 because the option will expire worthless. Sue, on the other hand, gets to keep her ABC stock worth $1,000 at this time. But if the price went down from 10, then it's no longer worth $1,000. That's her risk. But she gets to pocket the $50. And after March 4th, she can write another call option and do it again. But she doesn't have to actually wait to March 4th, or neither does Bob as the buyer of the contract. So let's say it is not March 4th, but Bob's prediction was right. The price did go up. It is not March 4th, but see, this 50 cents a contract on the day that they made this agreement, the contract was selling for 50 cents. But if the price goes up, then the contract value will also go up to, a predetermined price already, because it's all factored in. But it could be 80 cents, $1, which would be $100. And then Bob could actually, as the buyer, and he owns a contract, he could actually sell the contract back in the open market and pocket the difference as the price goes up or goes down. Sue, on the other hand, could do the same thing. If the price starts going up, she could pay the more expensive price and lose money. Or if the price did fall back down, so the price fell, it's no longer $10, it's below $10, and they have this agreement, it's not March 4th, the price of this option contract, 50 cents, will actually fall in price, so he loses his value as time goes on. Yeah, so the price of this will fall, 45 cents, 35 cents, 22 cents, 10 cents, 5 cents, and Sue, as the seller, could buy the contract back for less than what Bob paid her. Hope you're all following along with this. And pocket the difference. And she doesn't have to wait to March 4th. Yeah, but if they did wait to March 4th, then we'll be back to the bound of is it above or below $15? And if it is above $15, Sue will get the $15 per share at the end of the trading day. She'll lose her shares, and she'll get, because we're talking above here, so we'll get the right arrow up. So she will lose her shares for $15. That way, on that day, she'll get $1,500 for the shares plus the $50 she got previously when they wrote the contract. So she'll end up getting a whole $1,550 total for her shares that she may only bought for $10. So she actually made, $550, and all she had to do is wait till March 4th. So, but if it didn't, again, so if the price did fall, then Bob loses his premium. She gets to keep the premium at all times. She gets to keep the premium. She never loses that. And she gets to keep her stock if the price falls below the $15 strike price. And Bob's break-even price is $15.50. So Bob, the buyer of the contract at $15, needs the price to go to $15.50 for him to what they call break-even price. I would also like to add that Bob, the buyer of the option contract, does not have to wait till March 4th. If it's not March 4th yet, and the price has gone above the $15 price, which is called the in-the-money price, then Bob has the right to execute the option contract. And then at that time, he would have to pay the $15 per share, which is $1,500, to Sue, and Sue would lose her shares. But 95% of the time, option contracts do not get exercised early. And Bob cannot exercise the option if it's not in the money. So if it's not above $15, he cannot. He's powerless. So if this helps you out any, please subscribe and hit a like. That definitely helps me out since I'm a brand new channel. And I appreciate everybody for watching all the way to the end. Tomorrow Investing.